sector. Energy seeing the biggest gain so far in terms of sectors. That's up about 3%. Financials and materials also falling closely behind. Nancy Tengler is Laffer Tengler Investments Chief Investment Officer. Nancy, it's good to talk to you on this Monday. You have put out this note talking about how the markets, as you see it, sort of is heading for the light. There is some optimism that's building right now. Walk me through what you're seeing right now that leads you to believe that we could push even higher.
Thanks for having me, Aikiko. That is from my favorite group, the Traveling Wilburys, and my favorite song, Heading for the Light. But it is apropos to what we're seeing in the market. The light often being, to many investors, stimulus. But if you step back and look at the big picture, the consumer is in excellent shape, ironically. Consumer free cash flow is at historic highs. The consumer balance sheet is in good shape. Savings is up dramatically. And so you have this scenario where as we reopen, and if we get another stimulus check, that consumer stocks will do, consumer discretionary in particular, will do much better than many expect. And especially where we really like consumer discretionary is where technology or digitization and consumer meets. And so these are names like Disney, Roku, Square, and then the usual suspects like Chipotle, Starbucks, Walmart, Home Depot. These are companies that have taken advantage of digitization and are seeing their operating margins improve as a result.
Yeah, you mentioned those consumer names, and I wonder, I mean, thinking of a Disney, it's kind of one of those uniquely positioned to kind of see benefits regardless of which way this goes, right? If we stay locked down for longer, they've got the streaming side of the business. If we open up, they got parks that can come back. Is that kind of the way that you'd be advising clients to maybe look at these things, finding names like that at the intersection, regardless of how maybe the next few months go?
Oh, it's a great question. And absolutely, we keep hearing this debate. Should you be long value versus growth? And our firm just doesn't see it that way. We want to own great companies that are growing, not terribly original, at reasonable valuations. And so, and we want a barbell against longer lockdown, though I don't think that's even a scenario, and reopening. And so what we've done with our portfolio is we still like technology. So many of the names that will benefit will be those that are related to the cloud, and cybersecurity. So names like Now and Palo Alto Networks, but also then the semis and the semi equipment. And I think that investors are sort of stepping back from those names and assuming that, we keep hearing we're in a bubble. I just don't see it. In March, I was investing in March of 2000, and we were, at 27 plus times peak earnings. And the market this year closed out at 22 times sort of troughish earnings. So I'm not a perennial bull, and I do think there's risk at these levels. And so we've hedged our clients' portfolios, and we've diversified some globally because we think global synchronized growth is back.
Nancy, what do you make of some of these new companies that are coming into the market? We've talked a lot about just the growth or just the optimism that we have seen among investors getting into the IPO market. We've got another company we've been talking a lot about, like Bumble, that is coming to market shortly. But just when you say that you're looking at the tech space, you don't necessarily see a bubble, and yet when you see these huge spikes in the initial days of the listing of some of these companies, does that point to maybe some reason for concern around just the exuberance, the enthusiasm that we're seeing right now?
Yeah, so it's also a great question. So, a couple of years ago, we were all wringing our hands that the millennials would not get involved in the market, that they were seeking experience. They saw what happened to their parents in the great financial crisis, and now they're in, and we're seeing an environment very similar to what we saw in 99, 2000, where people were buying eyeballs on the internet and there were no earnings. So what I would say to that is that there is speculation, which is what some of this is when you have a company that comes public with limited earnings experience. You're making a bet that they're going to continue to grow, and oftentimes those bets work out. We're more interested, however, in buying companies that have a proven earnings trajectory or revenue growth trajectory that we can sort of hang our hats on. So I don't discourage people from investing in those names, but that's a different segment of the market and has its own characteristics, which I would agree with with you, are somewhat bubble-ishous, as they say.
Yeah, I'd be curious to get your take too on what we're seeing play out in Washington, D.C., just around these discussions and inflation risks. Something that we've heard kind of difference of opinion on when you think about Larry Summers weighing in, breaking from the Democratic kind of caucus around going big here. What do you think investors should be aware of when you look at that around the inflation risks and what we could see come through if the package is indeed $1.9 trillion?
Yeah, it is a concern, and add to that the increase in debt. We're already over 100% of GDP at 21 trillion. This just pops it up further. We've also already put stimulus, fiscal and monetary, into the system to the tune of about 70% with the last bill of global GDP. So I am concerned that we will see some price shocks. I would characterize them as price shocks, though, and not necessarily sustainable or secular inflation. And the reason I say that is there's still a lot of slack in the employment market. We are seeing companies onshore, so we expect to see, job growth and improved productivity. Spending in CapEx has gone up, which will enhance productivity, and that's how you grow without inflation. But I think this sort of, just it's never enough stimulus is problematic long term, and I think it's a bipartisan issue, not a Democrat versus Republican issue. The Republicans spent heavily as well, so I think we need to get this under control. One way is to grow the economy, but with all the increases in regulation, I worry about what the impact that's going to have on corporate America, and I don't think the market's paying attention to that.
All right, Nancy Tengler, Laffer Tengler Investments Chief Investment Officer. Appreciate you coming on here to chat all of that with us today.